Welcome to Mutual Fund Family.
Log on to mutualfundfamily.com for more info.
Hello friends, and welcome to the macro update. The government accounts that have been released for the period April to July so far indicate a fiscal deficit of 92% of what has been budgeted for the full year. Thus, the fiscal balances so far kind of indicate some caution going ahead. It would be interesting to look at factors that have worked favorably and some which are causing concern. Receipts are likely to be aided by the strong tax collections that have been seen so far. Both direct as well as indirect taxes are growing at a rate faster than what has been budgeted for the full year. The widening of the tax base post demonetization and higher tax payment compliance because of the GST implementation would aid tax receipts. The tax collections that have been reported so far for the period April to July do not factor in the total GST collections for the month of July. The last date of payment for GST was August 25th, and hence the tax collections for the month of July will rightly be reflected in the next data point. So to that extent, the fiscal deficit will be lower than 92% that has been shown in the accounts data. Contained global crude oil prices and the price hikes announced for LPG amidst direct benefit transfer would ensure lower leakages and lower concerns on the subsidy front. Moving on now to the concerns. So foremost, the RBI's surplus transfer to the government this year stood at around 30,600 crores, which was less than half of what we've seen in the previous 2 years. So to that extent, the dividend target that was budgeted would have to be marked down. Again, on the disinvestment front, April to July saw disinvestments to the tune of around 8,300 crores. So such a weak disinvestment seen so far could raise the risks of shortfall from what has been budgeted for the full year, which is 72,500 crores. The recently released GDP numbers at 5.7% for the quarter April to June reflect a double whammy from the cash squeeze announced in November as well as the uncertainty ahead of the GST implementation. Any persistence in these weak growth numbers could imply a lower tax collection going ahead. The preponement of the union budget this year has led to front-loaded spending from the government seen so far. So the government spending accelerated at 22% year-on-year between April to July this year vis-a-vis what has been budgeted for the full year at 6.6%. This was led by higher revenue spending, which means that the quality of growth going ahead would be impacted. While the arguments so far pertain to the centre's fiscal balances, announcements such as farm loan waivers this particular year in various states could also dampen the consolidated fiscal balances. So while on an overall basis, the fiscal deficit to GDP target of 3.2% remains achievable, in the absence of higher receipts, that could probably come at the cost of capital spending. Thank you all for your time and attention.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Thanks for watching. Drop a like, leave a comment, and don't forget to subscribe Mutual Fund Family.